Hello, 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 and welcome to the 5 secrets of investing. This is a live masterclass. I'm really excited for all of you guys to check this out, and welcoming some of you back. So investing secrets, value investing secrets is what we're going to be talking about tonight. So super excited for you all to be tuning into this. This is, I think it could be one of the last ones of this for a while, but you get to view it live, which is awesome. And you can't learn this at university. You can't learn this really anywhere, actually. So I'm thrilled that you guys made the time to jump on here live and participate. So if you want to get the most out of this, turn your cameras on so that I can see whether or not you have a glazed over look in your eyes. If my jokes aren't funny, I need to know so I can change that. But if you can have your cameras on, it makes it a little bit easier for me as we go through. So if you don't want to, totally okay as well. So we are recording this as well, so just so you know, but I'm really pumped to get this going. So I've got my beautiful wife, Alicia, there. She's co-hosting this, so she's in the chat there. So I just want to see if your chat is working. Just pop in there. Look, here's how it goes. If we go through this and you're getting great feedback or you're learning something or you're like, wow, that's something I didn't know. That's cool. I would love you to pop in a bingo in the chat, B-I-N-G-O. So if you can do that now for me just to see if it works. I just want to see what it looks like. B-I-N-G-O. There we go. Awesome. Great. Thank you so much. All right. So as we go, feel free to ask questions. If there's a cool question in there or a curly question of some sort, and Alicia sees it, she might read it out to me. So feel free to ask questions as we go, and I can give you some feedback as we move through it. All right. So who's ready to learn about the secrets of value investing? The 5 secrets of value investing. Just Tristan. Okay, great. One person. Yes. Excellent. Thanks, Marilyn. Great. Awesome. I'm just gonna mute you there as well. Thanks for jumping on and having your camera turned on. All right. So let's let Randy in, and we'll start this off. So for those of you guys who have seen this, who are in my investing mastery group, this is actually the replays in there already. So you guys have access to this as well, but this one will be a little bit different because there's a different crowd and different questions. So let's get to it. All right, share the screen. Let's go. Okay. So value investing secrets. How to buy $1 for 50 cents. Who here would love to buy $1 for 50 cents? Seems like a great deal, right? Oh my goodness. It's funny. I was at an event once, and this guy held up this. This is how crazy people get when it comes to money sometimes, because who wouldn't want to buy a dollar bill for 50 cents, right? Anyway, this trainer's at the front of the room, and he holds up this $100 bill, and he says, who here would love to buy this $100 bill off me for $50? Everyone's hand shot up. Yeah, that's a great deal. Awesome. And then he said, okay, who would love to buy this $100 bill off me for like $70? A couple of hands went down. He's like, okay, who would love to buy this $100 bill off me for $90? And the hands go down. They start dropping. It's just crazy, really, when you think about it. And he said, who would love to buy this $100 bill off me for $99? And almost all the hands dropped. But the reality is, it's a riskless profit. If someone wants to sell you $100 for $99, you would take it. So everyone's hands should have stayed up. But the way that our brains work when it comes to the psychology of money and investing, it's irrational sometimes. So I want to show you in this masterclass the core secrets that I follow personally to pick stocks, build a share portfolio that produces financial independence for us. And I'm going to give you the exact 5 secrets that we follow that I've learned over the last 14 years of wading through all the information that's out there, which is overwhelming, of course. I want to give you the 5 secrets, and I'm going to give you some bonuses too. So make sure you stay to the end because there is some awesome bonuses to get. And one of them is just going to blow you away. You're going to be like, oh my God, it's incredible. And again, ask questions as we go. And I'll look forward to seeing how many bingo moments we can get. So let's go to it. Value investing secrets, how to buy a dollar bill for 50 cents. All right. If you're here to learn about shares and investing, you're in the right place. Firstly, a disclaimer, I'm not a financial, I don't hold a financial services license. I'm not a financial planner. This isn't financial advice. Did this the other night, and people went out and just like bought the stocks I was talking about. I'm like, oh my God. I mean, you can do that, which is fine, but it's not a recommendation from me. And it's definitely not financial advice. So please do your own research first before you do that, and seek expert advice from a financial planner if you really must. Okay. But now that the disclaimers are done, let's move on. All right. What is value investing? What is value investing? Well, this gentleman here by the name of Benjamin Graham actually coined the term value investing. He's the grandfather of value investing. All right. He really developed it, right? And Ben Graham, he's the author of The Intelligent Investor, and he said, at the core of value investing, it's the strategy behind buying a dollar bill for 50 cents. Okay. So to put it another way, he wanted to buy companies at a discount of 50% or more of their net worth. So who wouldn't want to buy a company for 50% less than what it's really worth, right? And that's what he discovered. And there's a fellow by the name of Warren Buffett, arguably the greatest investor who ever walked the earth. And this is Warren Buffett's direct mentor. Okay. This is Warren Buffett studied under Benjamin Graham at Columbia University. All right. So he is the founder of it. So Warren Buffett's business partner, Charlie Munger, says that all intelligent investing is value investing. We are acquiring far more than what you're paying for. So you get to have, tons of value for half the price. All right. Now, this is the secrets of investing in shares, guys. I mean, there's a lot of things out there people look at, like a technical analysis and selling short and options and derivatives and FX trading and bigger. That is just so not investing. That's speculation. And this is the only type of investing that made sense to me. When I first learned about it, it just dropped like a penny, pardon the pun. It was like a light bulb went off, and I was like, that makes absolute sense. It makes and I've never strayed from this strategy of value investing. So this is where the 5 secrets come into it, because there are some core secrets that you must apply to have success as a value investor. All right. So if you've always thought about wanting to be in stocks, I'm so glad you showed up to this or you're watching the replay. And once you learn this, I hope it's like a light bulb moment for you too. So the 5 secrets to value investing. Here we go. Ready? Secret number 1, only buy high quality businesses with a wide moat. Don't worry, I'm going to show you what that means. Secret number 2, only buy them when there is a margin of safety. Okay, we're going to explain what a margin of safety is. Secret number 3, don't swing at every pitch. Do not swing at every pitch. Secret number 4, the money is made in the waiting, not in the buying and the selling. Secret number 5, stay within your circle of competence. Seems simple, but people contravene that all the time. Bonus secret number 1, just going to blow you away with that. And then secret number 2, you're going to enjoy that as well. It makes everything a lot easier. Okay. So who's excited to learn about the 5 secrets? Pop me in the chat if you're ready to learn about the 5 secrets. Let's see. Me. Aaron's ready. Matt Stevens. Awesome. Marilyn. Great. Excellent. Okay. Let's go. Secret number 1, only buy high quality businesses with wide moats. So when I'm talking about buying businesses, I hope everyone understands that when you buy a share of a public company, so you're buying shares on an exchange, like the Australian Stock Exchange or the New York Stock Exchange, you're buying a share in a business. It's a share in a public company. So when I say buy high quality businesses, I mean buy shares in high quality businesses. And high quality businesses have wide moats. Okay. So I want to explain to you the secret number 1 so you understand it, so you know how to identify that, and so you know exactly what to buy. Because one of the biggest hurdles is, well, what stocks do I buy? There's so many out there. Which ones do I buy? So I only buy high quality. And this is Warren Buffett. He says, I only try to buy stocks in a business that are so wonderful that an idiot can run them, because sooner or later one will. Okay. So buy good quality businesses that an idiot can run. And I'm thinking like, Coca-Cola, there's not too much tech associated with selling sugar water. It's pretty simple. Wrigley's, Mac 3, Gillette razors, pretty simple, plastic, right? Amazing businesses that an idiot can run. Okay. So how do you determine what a high quality business is? Well, there's this concept called having a wide moat. Okay. And in the old days when castles were under siege, the villages obviously would be protected within the kingdom by a moat, or the castle would be protected by a moat. Why? Because you can see in this picture, it was hard to cross the moat. The drawbridge goes up and the enemies can't enter the castle to destroy it. Okay, so it keeps its integrity. It's still there. And so with businesses, it's the same. Because when a business arrives and it's got big profits, right? Like I'll give you an example, Afterpay. Who's used Afterpay before, right? Afterpay is a brand new business, and it started creating profits. Like it was a new technology. It's like, wow, hey, we're new. What's up? We got our castle here. We're doing business. We're making massive profits. And guess what happened? boom, the competitors came and they said, hey, we want some of those profits too, Afterpay. And Afterpay's like, oh my God, we're going to get attacked. We have to build a moat. And they don't really, the only moat they have is a first mover advantage, and they don't really have a moat. So right now, PayPal's created an Afterpay, CBA's created an Afterpay, like it's actually getting attacked and it doesn't have a moat. So sooner or later, other competitors are going to take their profits. Okay. Now that's not a long-term business. It's not a high quality business. All right. So the whole idea is to have a really wide moat and really deep. And maybe if you can put some piranhas in it so that people can't get it, so that no one can compete with you. All right. So as an example, in the world of business, it's called a competitive advantage. And it just prevents other competitors taking away your profits as a business. Okay. So some companies that have big, wide moats that no one can touch are Apple. Okay. It's so far ahead of its only competitor, which is Samsung. It's just got a huge moat. No one can touch it. All right. And other companies that probably have moats you can think of are like Facebook. No one can compete as a social media platform against them. Microsoft, like it's so, no one else has Excel spreadsheets and PowerPoint. Like you just can't compete with Word. It's just, it's a monopoly just about. So these are the types of businesses. Google, like who really goes and searches on a different platform to Google? Anyone? When you want to search, you don't even say search, you say Google it. It's like, it is the ultimate high quality business, Google, right? It owns pretty much the monopoly of search. This is what I'm talking about. You can't touch it. Its moat is so wide and so deep, you can't touch it. So how do you determine if a company has a wide moat? I'm going to give you the exact, I'm going to show you, okay? Here's an example of when it has a wide moat. Now it's subjective. There are other parts to it, like having a great brand is very important, of course. If you can have a monopoly, that's really good. But more often than not, a company with a wide moat has this. It has a high return on equity. Okay. Now you don't have to be great at math to be good at investing. So just relax. We're not going to get into like numbers and fractions and stuff. Like if you hate math, then great. You're going to love this because there's a few ratios you can learn that show you what you ought to be buying when it comes to shares. So to identify a company that's got a wide moat, it has to have a high return on equity. Okay. And return on equity is really simple. It's the company's net income. Okay. Its annual income divided by its net assets. So it's assets minus its liabilities. So the assets, its core net assets that it's using to generate profits, all you have to see to determine return on equity is take its net income and divide it by its shareholders' equity, which is its net assets. Okay. So it shows you basically how good a company is at creating a profit, $1 of profit, and how good it is at reinvesting back in its business to create more value. Okay. And this is a great sign of a wide moat. So if we take Apple, for example, it's got $86 billion in net income and it's got net assets of only $64 billion. It's producing far more income than its asset base. It's got a higher return on equity, 135%. It's insane. It's actually one of the highest you can get. Just put in perspective, a really high, good return on equity you want to look for is anything above 20%. Anything above 20% is really good. It's got 135%. It's got one of the widest unpenetrable moats ever, which means it's going to be around for a really long time, which is really important when we get to the other secrets. You want to be able to put your money into an investment like this and leave it for a long time to compound. Okay. That's where the money is made, which we talk about shortly. All right. So return on equity is the first place to look. And it's really simple because other people do the calculation for you. You don't have to do the calculation. I'll show you how to do that, right? Really simple. So some other companies that have wide moats, Mastercard, Microsoft, Facebook, Commonwealth Bank, Apple, Google, and Amazon. Really wide moats. No one can touch them, okay? Secret number 2, only buy them when there's a margin of safety. Only buy them when there's margin of safety. What do I mean by that? Well, a margin of safety is like, it's like an insurance policy against the unknown future, okay? Because it's like this. When people build a bridge, okay, there's a bridge being built near our place right now. Now, there's going to be trucks going over that bridge that weigh like 2 tons, right? I don't know what trucks weigh, but they're probably a ton. They're really heavy, okay, obviously. So do they build a bridge that takes just a ton of weight or 2 tons? Or do they build a bridge that takes like 1,000 tons? Engineers build bridges to take the weight of way more than what's going to go across it. Why? Because they want to make sure there's a margin of safety so that someone doesn't roll across a bridge and then like it breaks and fall in the water. It's the same with stocks. If you buy high quality companies, but you pay a high price for them and something happens to their earnings or something happens in the market and it falls, you're already in the red. You're already losing money. So you've got to plan for uncertainty. So what you want to do is wait for the moment where they're selling for cheap and you can factor in a margin of safety. Okay. So how do you determine if there's a margin of safety? When is the right time to buy a company when you can see a quality company like Apple? Should I buy now? Should I wait? Let me show you. The first way to understand if there's a margin of safety is to first calculate what the stock is worth. What's it really worth? What's the intrinsic fair value of this stock? Okay. What's the value of the business? Okay. Because as good as companies are, like if, for example, if your neighbor had an amazing lawnmower business and you're like, this is amazing business, creates so much profits. I see him driving really nice cars, a nice house. This is a great business. But if he said to you, hey, I've got this lawn mowing business and it's going to cost you $1 trillion to buy it off me, you're like, $1 trillion? Man, it only like produces like 500 grand a year income. Why would I pay $1 trillion for it? He's like, well, that's what I mean. Like, not great businesses aren't worth infinite amounts of money. There is a nice, reasonable amount that you'd buy it for. And same, the value of the business divided by the stocks is the value of the stock. And too many people are paying way too much for a stock. Okay. So that's the first thing. The second thing is only buy it when it's selling for 50% off. So if you know the value of it, if you know that Apple is worth $146, only buy it when it's selling for like $75 or $100. If you can, wait for that time to come. Last March, it happened. You could buy wonderful businesses when COVID came and the whole market crashed 30%. You could buy wonderful businesses like this for almost half price. The opportunities do come. Okay. So there you go. So how do you calculate the fair value of a stock? How do you know what a business is worth? Don't let this freak you out. This is a freaky formula. I know. And if you hate mathematics, this is going to hurt you, but don't worry. You don't need to worry about this because this is just I'm just showing you how you calculate the value of the stock. Thankfully, other people have done it for us, which is great. Okay. I'm going to show you all the cheat codes here, right? So you don't have to be an expert, an analyst. So basically, you work how it works with fair value is this: to work out the value of a business, you kind of estimate based on its current profits what cash flows every year it's going to produce into the future. Okay, so what's Apple going to produce in cash flows into the future from selling its phones and stuff, right? And then you discount those cash flows back using an interest rate to arrive at a current value today of what that business is worth. That's why I love stocks. You can't do that with crypto. You can't do that with currencies. You can't do that with assets that don't produce income because you can't discount the cash flows back. So you don't even know what it's worth. So how do you know when to buy it? You don't. But with stocks, you do. So what you do is you decide what's the business worth today. You divide by the number of shares that it's got outstanding, and that gives you the value per share. Okay. Once you know the value per share, you can decide then if it's worthwhile purchasing now for 50% off or whether it's overpriced. Okay. So check this out. This is how you find other people have done the work for us. All right. So check it out. The fair value of, say, Beach Energy, which is an Australian oil company. Look at this. There's 1,500 undervalued companies right now in Australia. There's a lot. You know what to choose from. Okay. We'll get to the other secrets to explain what to choose in a second. But I just want you to know that the fair value of Beach Energy, which is an oil company, someone's already worked out it's around about $2 a share. It's around about $2 a share. G8 Education, which owns lots of kindergartens in Australia, one of the biggest, someone's already valued it's about $1.70 per share. That's the fair value of the stock. That's what it's really intrinsically worth. Okay. And GCY is worth 56 cents. So people have already calculated it. All right. You can see on the left, that's what it's selling for. So you can identify if it's actually selling for a discount or not. Okay. I just want you to know that someone else has calculated it and they're fairly accurate because they're pretty smart analysts that are on it. Right. So check this out. When do you buy it? When do you buy it? So check it out, right? I'm going to draw on this screen here just to make this simple for you to understand. So let's say you work out that we're going to use Apple again. Let's say that Apple is worth $130 a share. Okay, $130 a share. You know, some analyst, as you can see, you found out it's pretty easy to find. Oh, okay, it's worth $130. Today in the marketplace, Apple's selling for $148, okay, a share. That's what it's, that's the price of the stock today, $146, okay? Or $148. That's what it's selling for. But you know that it's worth 130. So do you buy it today for 148? You're overpaying. You're paying more than what the business is worth. I know it's a great business, but you're overpaying. Does that make sense? A lot of people buy here. They just buy at the top. They just buy all of it when it's overvalued. Warren Buffett, the best investor of all time, he bought Apple in 2016 and he bought it for about, I don't know, like $60 a share or something. Very, very low. He bought it for 50% off. He bought it when no one wanted it. So he bought it down here. He bought it here. He's buying a dollar bill for 50 cents because he's buying it for the purchase price is way less than what it's worth. Does that make sense? Just nod if that makes sense. Yeah. So when you see a margin of safety like what he saw, that's when you know that that's a great quality business selling for a discount to its fair value. And too many people are buying it when it's actually too dear. When do you go and buy clothes? Before Christmas or after Christmas when there's a Boxing Day sale on? You go to the shops when there's a sale on. It's the same with stocks. You only buy them when they're on sale. Okay, there you go. But that's a margin of safety. So check it out. Ready? Look at this. You can see that Beach Energy, it's the price of the stock is $1.21. The price, you can buy it today for $1.21, but it's worth arguably $2. Look, you can buy it for 44% off, right? And there's lots of these in the marketplace, okay? You can see. So it is easy to identify which ones are selling for a 50% discount. You can find them. They do pop up, okay? Other people do the work for you. You just got to know where to find it, right? And in my Investing Mastery course, I go through and talk about where to find this stuff, all right? So it's nice and simple to find if you know what you're looking for. So let's say you found a quality business like Apple, and you're like, wow, it's actually selling for a lot less than what it's worth. That's interesting, right? Or maybe you look at these stocks and you say, well, Beach Energy, BPT, maybe I can buy that. Look at that, it's 44% off. Should I buy it? Bum. Secret number 3, don't swing at every pitch. There are currently 1,500 undervalued stocks in Australia right now. Don't swing at every pitch. Wait for a great pitch and hit a home run. Because if you deploy some money into a stock and it's a wonderful company at a great price, you can literally put your money there, not touch it for many years, and you can make a fortune doing that. Okay, so you can wait. You've got time to wait for the perfect pitch. Okay, so here's the thing with don't swing at every pitch. There's a guy called Ted Williams in 1940. Well, 77 years ago, he was the last player to bat a 400. Okay, with a season average of .406, which is a very high batting average in baseball. So he wrote this book called The Science of Hitting. Like, Ted, how do you hit that batting average? It's ridiculous. He's like, well, here it is. And he wrote this book called The Science of Hitting. And what he shows in The Science of Hitting is that in baseball, if you don't swing at it, you can't get a strike. Same as stocks. If you don't buy it, you don't lose, you still get your cash. Great. You don't have to purchase stocks all the time. You can have the ability to wait. No one's sitting behind you going, swing, Aaron, swing. You don't, right? You can wait. So what Ted Williams used to do was like, he wouldn't swing at every pitch. He would wait until the pitcher pitched a perfect pitch. And the perfect pitch was, see where the red dots are there in the middle? He waited till it hit the perfect hitting zone. He called it the hitting zone. And once it was there, he swung. And that's how he increased his average of succeeding. Okay. So when it comes to stocks, it's the same thing. Wait for the perfect pitch. Okay. Don't swing at everything. So here's how I'm going to help you do that. Warren Buffett taught me this, and I want to impart this wisdom to you. Okay. To help you not swing at every pitch, imagine that you had this punch card in your wallet. Okay. If you still carry a wallet, and on this punch card, every time you bought a stock, you put a punch hole in it. And that meant you had one less opportunity to buy stocks, and you only got 20 punches your entire life, right? If you look at Warren Buffett's portfolio, he's made billions and billions of dollars on like a handful of stocks. That's it. Coca-Cola, American Express, Bank of America, Apple, and maybe Moody's and another. Not like there's 6 or 7 great businesses. So you don't have to buy lots of companies. What if you had this punch card and you just swung at the very best opportunities when they arose? Okay. You would think long and hard behind what stock am I going to actually buy?
And too many people like punching like left, right, and center. Like, oh, I'm going to buy this today. I'm going to buy that. I'm going to buy that. No. I've bought my entire life. I've bought 14 stocks ever. Just 14. Now I only have 6 punches left. I'm running out, right? So I'm very careful with what I buy, because I know if I find one great business and put some money in there, that it can make us millions of dollars. Okay. I'm going to show you some examples. So chill out. But that's how you don't swing at every pitch. Pretend you've got a punch card. You've only got 20 swings. Wait for a good one. Okay. So secret number 4, the money is actually made in the waiting and not in the buying and the selling. Too many people like buy this, sell that, buy, sell, buy, sell. You see it on Wall Street, like buy, sell, buy, sell. They're traders. Traders don't make large amounts of money. You can't scale that. Okay. And Warren Buffett and all these super investors, they've all made money by what I call sitting on their butt. The best money is made doing nothing. Okay. So the money's made in the waiting, not in the buying and the selling. Okay. In fact, there's this quote, and this is what happens when investing. It's the lack of ability for people to wait that crushes them. They just get they're so used to working hard for their money and being busy, right? That they think that's how you do it with stocks. You don't. It's made in the waiting. All of humanity's problems stem from man's inability, or woman's inability, to sit quietly in a room alone. And this is why people aren't making money in the stock market or in property. They're buying and selling houses too much. They buy and sell stocks too much. They're too active. They got to work less. So this is what people think it's like to invest. I've got to have all these papers and watch CNBC and watch this, watch that, right? Do all this work. Buy, sell, buy, sell. No. Share investing is a gentleman's activity or a lady's activity. It's where you invest in great pitches, great businesses with a margin of safety, and sit in a chair and make lots of money. That's how it works. Okay. So you understand that. All wealthy people know this, that the money is made in the waiting. Okay. So what do I mean by that? I'm going to show you some examples. Okay. If you and these examples come from in my investing mastery course, I talk about this particular software that you can go and check out snapshots of companies, right? It's really helpful. So I'm going to run through some snapshots here. Costco. Who's shopped at Costco before? Wonderful business, high return on equity, great brand, big wide moat. And you could have bought it for quite cheap back then, right? $55. It's now almost what's $400 and something, $440 now, I think. So in 10 years, it's returned 700% return in 10 years. Now, just to put that in perspective, property's returned 100% in 10 years. That's why they say property doubles every 10 years, right? Look at this, 7 times that, 700%, right? It's crazy. And look, all you had to do was buy it back then and wait. Let your money do the heavy lifting for you. The stock will do all the heavy lifting, okay? Macquarie Group, Australian company, I bought it at $20 a share back in 2012, 750% return in 10 years, 7.5 times better than property. How about this? Microsoft, 1,000% return in 10 years, 10-fold return. All you had to do was buy it for like $40 and wait. Moody's, this is one of those businesses that an idiot can run, because in 2008 financial crisis, it was run by a bunch of idiots, right? It was like largely caused most of the financial ruin. But look at it. It kept going. Even after the GFC, it's still in existence. You can't beat this company out. Its moat is so wide, you cannot penetrate it. 10-fold return in 10 years. Google, 12.5 time fold return, a 1,250% return in 10 years. CSL, Australian company. It's going to produce all the vaccines. A wonderful company. Very high return on equity, wide moat. It's got monopolies in bloody blood plasma. 15-fold return. 15 times better than property. 1,500%, 10 years. Mastercard, one of the best businesses ever to exist. 18-fold return in 10 years. Oh my God. Amazon, 20-fold return in 10 years. The money's in the holding and the waiting. Okay. Commonwealth Bank, here's a great example. One of my favorite stocks in Australia anyway. People who bought shares when it listed on the stock exchange in 1991, if you had invested $2,000 back then and reinvested your dividends, you'd now have almost $148,000. That's a 65-fold return. 65-fold. That's 6,500% in 30 years. Yeah, that's wonderful, right? That just all you had to do was sit on your butt and do nothing. Oh dear. Okay, so you get my point, right? Secret number 4 is the money's made in the waiting, not in the buying and the selling. Okay. Secret number 5 is the last secret before I come into the bonuses. And secret number 5 is, this is where a lot of people, the wheels come off it. You've got to stay in your circle of competence. Okay. So check this out. What I mean by this is this. This is Warren Buffett's business partner, Charlie Munger. And he's one of the wisest guys in the world. His IQ would boil soup, I think. He is really, really smart. But he was also really rational. So you don't have to be like a super intellect to be great at investing. You have to have temperament and rationality. And he says this: all I want to know is where I'm going to die, so I never go there. Like if I knew I was going to die in like Sydney, why would I ever go to Sydney? I would never go there. So what I'm talking about when it comes to this is, why do people go and invest in things they don't understand? Because that's typically where they die. Okay. One of the secrets to successful investing is to avoid anything that you don't understand and anything that's too hard. I don't know about you, but I like sitting on my butt making a lot of money. I think if it's too hard, put in the too hard basket and don't touch it. Okay. So what I mean by that is this: stay in your circle of competence. Stay with identifying great businesses that are selling for a margin of safety. You can buy once and hold for a long time. That's it. That's as simple as it needs to be. Anything else is where you're going to die probably. So check it out. Ready? Avoid IPOs, initial public offerings. Just avoid them. Okay. Avoid margin lending, borrowing money to buy stocks. Avoid first mortgage lending. Avoid bonds. Avoid penny stocks. Avoid short selling. Avoid binary options and people on Instagram that hit you up. Hey, I'm a binary options trader. Avoid trading. Avoid day trading. Avoid FX trading. Avoid gold and silver. Avoid oil. Avoid commodities. Avoid crypto. You don't need to be great at this stuff. You just don't. Like, I know that there's people that have made money here, but this is going to take a lot of time and effort, and it's not how you need to make. Like, there's more wonderful things to do in the world than sit in front of a screen all day trading. Let me tell you, you don't want to make money doing that. You want to make money lazy man's way, right? Buy once and just hold. So this is what I mean by circle of competence. Too many people move outside good quality investing principles that are boring and time and tested and true and proven, and they go to these weird new wonderful fads and novelties, right, and crazes, and they get involved to the drama hook, and this is where they die. Okay, so this is what I say to people. They say, Lloyd, do you want to like invest in this IPO? Do you want to come into crypto? You want this? I'm like, listen, I'm smart in areas and I stay in those areas. And I learned that off Tom Watson. He used to be the CEO of IBM, one of the smartest guys ever to run that company. And so I just stay in my circle of competence. I don't need to know about crypto. I don't need to know about that. I have no, obviously, if you listen to my podcast, Money Grows on Trees, you know I have an opinion about it, but I don't need to know about it. So if someone asks me, I'm like, look, it's not my area of competence. And they leave me alone. Oh, okay. Sensible. Why? Because I know I'm going to die there. I don't want to go there. Okay, so stick around your circle of competence. Stay with these time and tested true principles of investing. Okay, and you'll never go wrong. Okay, so how do you find stocks, okay, like this that are high quality, selling for a margin of safety? They're going to do this. How do you find? What's the cheat code? How do you do it quickly? Okay, here's a bonus secret. It's called cloning. Cloning. This, when I showed Alicia this, my wife, she's like, are you kidding me? That is like the ultimate cheat code. Who had video games and they get the cheat codes? You always find the cheat codes on you're like, hunt for the cheat. I'm going to give you the cheat codes for investing. It's going to blow your face off. Hopefully it's going to blow your face. Well, maybe not off. Hopefully it's just going to blow you away. So secret number 1, the bonus secret is this. And I share this in my investing mastery course. And it's the ultimate cheat code. There's actually a software where you can find out where the super investors are investing their money. Okay. And it means that I can clone them. I can copy them. So why would I think that I'm smarter than people like Warren Buffett and Charlie Munger? They've got all the brains, all the experience. Why don't I just copy them? And that's what we do. We just copy. Why would you try and recreate the wheel? Just copy success. So what you do is you go here. It's Charlie Munger. Okay, he owns Bank of America, Wells Fargo, Alibaba, USB, PK. Great. I'm going to look at these companies and go, well, there seems to be a lot of people holding Amazon, a lot of people holding Microsoft. These guys mainly hold the similar stocks. They buy quality and they buy it when it's marked down. That's it. You can just go and copy them. Find the ones in here you want and you copy and you're done.
It's the ultimate cheat code. My ego says to me, hey, you fancy yourself? You're not as good as these guys. Why even bother? Just go do what they do. Okay. You can do that. It's available. It's the ultimate. It's so good. Actually, going back to this, I used this, and I saw that Warren Buffett bought Bank of America in 2011. I think it was 2012. It was. Anyway, I found out that it was selling for like the stock was worth about $15. Oh, 20, maybe a bit more, $18. And it was selling for like 11. I was like, oh my God, I can buy $1 for 50 cents. Great. And I went and looked at this, and Warren Buffett had just bought billions worth. He just converted his note from 5 billion into shares. I was like, oh my God. So I backed the truck up, put $80,000 in it. Within 12 months, doubled my money. So yeah, you can do what you want, but I just copy the success. And I worked backwards from it. You don't just go blindly into it. I looked at the metrics. I looked at things I understood so that I believed in it too, because I didn't want to just blatantly copy him. I wanted to make sure it made sense for me so that I was comfortable too. So you do start here and work back. I'm going to show you how to do that. It's really simple. Bonus ticket number 2, before I show you a live example. This is going to be so much fun when I give you guys a live example. You're just going to hopefully blow you away again. Bonus ticket number 2, the checklist. Okay. So, you know, I don't know if you guys knew this, but the B-52 bombers they used in World War II. You ever seen them before? What was happening when they started those was that they were crashing a lot. And what happened was they realized the pilots before they got in weren't checking certain things. And this is where flight checks came from. And it started to come into commercial aviation. That's why they do, hey, let's do a flight check. Before every flight, they do a flight check. And that's because they don't want to crash. So they do flight checks. And it's the same with stocks. You've got a checklist. You do a flight check. Okay. You do a stock check. This is what happened when they started giving people intravenous in surgery, intravenous drips. And there was no checklist, and people were dying from infection. So they have an intravenous checklist. So the same with stocks, you have a checklist. Okay. So you want to make sure you've got a nice checklist. You can tick off it. Does it tick this? Does it tick that? Yeah, it does. Great. Now I'm ready to buy it. Okay. So some good questions are, is there too much debt? Is the management competent? Can an idiot run the business? Is it a win-win for the entire world? Is it going to do well for the planet? Can it be decimated by a low-cost engine? Is it got a high return on equity? Has it got a low PE? All these things are important. And that's why having a good checklist is imperative. And you can expand your checklist. It only takes about 30 minutes to go through a good checklist to go, okay, I'm ready. Truly. So in my investing mastery course, I actually give everyone my own checklist. There's 10 things on it. And I just go boom, 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 boom. And if it checks most of them, it's kind of like, okay, I'm ready. Right. But it's just like having a flight check. So you don't crash. Okay. That's the second secret that I use. So who's ready to see a live example of what I would go through to actually find a stock that I would buy? Comment in the chat, ready, if you're ready to see this. Aaron's ready. He's like, hey, hurry up, Lloyd. Just give me the thing, right? Todd's ready. Ken's ready. What's up? Cool. Okay, I'm going to show you a real life example. Now, last time I did this, people ran out and bought the stock. Now, I had one lady, God bless her. I don't know if she's on. Was it Karen? I think it was. But she went and she bought it. And I'm not suggesting do that by any means. Please don't. But she did. I can't stop people doing it. Anyway, she was up $400 in like 4 days or something. It was crazy. Anyway, I'm sure she's going to make lots of money from it, but just make sure you do it at your own risk and you work backwards and do your own research. Okay. So please don't run out and buy this, but here's a live example because they don't come up. Remember, the fat pitches rarely come up. We wait for a big fat pitch. So it just happens to be one available right now in the marketplace that I love. Okay. So there you go. Real life example. It's called Baba. If I know you guys know what that is, it's called Alibaba. Alibaba. Okay. So check it out. Live example. What happened was I'm going through the software to check what the super investors are doing. And I see, my good old friend, Charlie Munger, the man whose IQ could boil soup. Wonderfully smart gentleman. Had been, arguably one of the best investors ever. He bought Alibaba. I'm like, oh, he bought $40 million worth of Alibaba. He probably knows a thing or two about that I don't. So I was like, I might go check that out. So step 2, I checklisted it. So step 1, I used the bonus. I used the cloning mechanism. I cloned, found it, checklisted it. And this is what I found. I looked at it, pulled up the metrics. I was like, okay, Alibaba. Yeah, Alibaba. Oh, look at that. Fair value, 260. Selling for 194. Selling for a discount. Wonderful. Great. So here's what I looked at. I looked at some metrics off my checklist.
And I went through my checklist and I went, okay, does this have a wide moat? Let's take a look at the return on equity. Holy smokes, 157, 27, 39, 7. Yeah, it's high. Remember, 20 plus is high. Great. Oh, and by the way, it says it. Economic moat, wide. Wonderful. Check that box. Then I'm like, is the business growing? Is it growing its profits? Look at its earnings per share. Went from $1.80 to flipping $55. It grew its earnings by like 30-fold, 40-fold. It's incredible. Is it growing? It's one of the fastest growing businesses in the world. Has it got free cash flow? Is a lot of cash generated? Is it good at producing cash? Yes, it is growing its cash flow. And is it relatively cheap? Okay, price earnings tells us that. A price earnings of like anything around 20 or below is good enough. Like, and that's on my checklist because sometimes it's ridiculously high. Now, there are some metrics to that make it even better that I share in my course, but that's a quick back of the fag packet or back of the envelope check. So I checked it out. I'm like, okay, reasonably priced. This looks pretty good. And then I looked at this and I'm like, I can see that you can see, I'll pull out my little annotator. I could see here, I'll use green. I could see here that it's free cash flow. So the cash that the business is producing is actually going up drastically. But what's interesting is the price is falling. The price of the shares are falling, but the cash and the earnings are going up. This is ridiculous. This is a perfect pitch. I was like, oh my God, what kind of idiots are selling this? And of course, it's big funds because they're getting scared about something. So I wanted to check, what are they scared of? What's forcing people to sell this amazing company? What's going on? So as part of the checklist, I got a checklist there saying, do your own research and make sure you know why that's happening. So I checked it out. It's not that hard to see. It's in the news everywhere. China's tightening up the competition rules for tech companies. And that's normal. It happened to Facebook. It happens to all the companies in the United States, everywhere. It's normal. But for some reason, because China's a communist country, they're like, oh my God, the world's caving in, the ceiling's falling down, oh my God, we're going to die. All the companies are going to win. No, it's just doing normal things that make it better for the economy to manage monopolies. It's great for the consumer. It's great for companies. It's good for markets. But look at this. All the news is coming out and everyone's freaking out and selling their stocks in amazing companies. They're throwing the baby out with the bathwater, if you've ever heard that saying before. So that's why I'm like, oh, this is why they're getting upset. There's a lot of, so what you want to look for is high uncertainty, but really good quality business. So there's a lot of uncertainty politically with China right now. It's like, oh, are they going to go to war with Taiwan? Are they going to like clamp down on tech? They are. And everyone's selling their stocks. Perfect. Fat pitch, right? So here's what I looked at. I did a bit more research and here's what I found. It's not hard to do this, by the way. There's apps you can use, right? And it's simple. I found this out. I found out that Amazon actually has product volume of 386 billion, okay? Whereas Alibaba has turnover of 1.2 trillion. It makes Amazon look like a little baby. It's like almost 4 times the size as it. And they expect it to double to 2.5 trillion in the next few years. And it accounts for 25% of all retail spending in China, which is the largest country in the world. 25%. And then I found this out. Fundamentally, because remember, everyone else finds out the value of the company. Fundamentally, the company is undervalued by not 50%, by 100%. You can buy a $2 bill, well, a dollar bill for almost $0. You can buy a dollar bill for a cent. That's what this is, guys. I was like, oh my God, this is the perfect pitch. Perfect. I'm interested. This is going to make sense. Great. So then I did a quick compare. Because remember, the money, remember the secret? The money's in the waiting, not the buying. So I wanted to see how long the runway is that would grow. I want to see what it can do in the next 10, 20 years, right? So I'm like, it's similar to Amazon. It's bigger and better, and there's multiple businesses. Like it's just so much more. It's just a way bigger and better business than Amazon, right? But it's the most similar business to it is Amazon. So check it out. Ready? So I did a comparison. Amazon in 2011, which is 10 years ago, was selling for $173 a share. Okay. Today, or a month ago, Amazon's selling for $3,500 a share. There was an enormous amount of money to be made buying and waiting in this stock. Is Alibaba similar? Yeah, relatively similar. I wonder what it's selling for. Cha-ching, $172. We have ourselves a long runway, and the likelihood of it growing is very high, and it's going cheap. It's quite amazing, really. So I'm thinking to myself, well, if it's $172 a share now, ultimately down the track, obviously as it grows and grows and grows, it's going to, I'm not saying it's going to be this, but it looks pretty promising. Okay. It doesn't mean it's, I mean, it's probably around about a third of the market cap now of Amazon. So it's about a third of the size, but it's way bigger. So really from this price, it could triple, basically is what I found out really when I was thinking about it. But the runway's long. It could 10 bag. It could be one of those ones that's 2,000% return that we saw. 20-fold return, which means 20-fold, right? Which means if you put 10 grand in it, that can turn into $200,000 by doing nothing but waiting. You put 100,000, that's $2 million. Done, right? That's why I love shares so much, okay? Check it out. There's always risk in share, but look, can things happen in China? Yeah, of course. Without saying everything, risk comes with everything. But here's the thing with investing. You got to look at the facts and you got to weigh out the probability of really bad things happening to a company that's so ingrained. Alibaba is so ingrained in China as a company that it's integral to the economy. They can't let anything bad happen to it because it would crush the GDP growth. They're not going to, right? And it's got a very wide moat. It's basically got monopolies almost, right? So I think the odds of us doing pretty good are pretty good. Okay. Yeah, there's always a chance you can lose, but you know what? I'm prepared to put some money towards it. And if it loses, it loses, right? So check it out. I assess the stock against my current portfolio. So we didn't have any exposure to China, but China is going to be the largest economy in the world in 2028. And so I'm like, well, I want to be part of that. There's huge tailwinds there to be part of. I mean, I've got Australian stocks, American stocks. Why wouldn't we want to be in China? So I'm like, well, what if we allocate 20% of the portfolio there? Don't put all your eggs in the one basket. Just say, hey, let's put some money there. And this is about being sensible with what we call diversification. So just assess it against what your portfolio is doing and put some there and let it grow and don't touch it ever again. Yay. Make money while you're waiting, doing nothing. This is the secret, right? So when I discovered that, the final step in step 6 is to putting a live example together is to back the truck up. So when you see it raining outside, cats and dogs, well, if it hasn't rained and you're a farmer and it hasn't rained for a long time, okay, you're thirsty, do you take out a little thumb thimble or do you take out a big bucket? Take out a big bucket. So here we go. We're Ted Williams. We're pitching. We see a good quality company selling for almost 100% below its fair value, which is a huge margin of safety, okay? It's a perfect pitch. It's right in the hitting zone. And it's within our circle of competence. And we can see that it's got a long runway to wait. So we're going to make a lot of money waiting. So what do you do when you see that? You don't take out a thimble. You swing big and you put in a fair amount of capital. So we put in a fair amount of money because I'm like, you only get one of these shots every so often. Okay. So when you see it, you swing, you back. It's called backing the truck up. Okay. And of course that comes with backing the truck up comes with experience. So I'm not saying just go and grab all your money and and back it up to that. But that's an example. That's what we did with Bubba, right? So that's a live example of doing, buying a perfect example of this webinar. Okay. So I want to share with you some successes from my investing mastery course. Okay. So the people that I've showed how to do this, when they've implemented it, there's obviously a level of, because it's education. Once you have the education and you're empowered. And the last thing you want to do is have to depend on someone to tell you what stock to buy or tell you what to do with your money. So the people I've taught throughout my course, right? I asked Cal the other day, since I taught you what you know of investing, how much do you think you've made? 250,000, right? He's in the army. Here's Soph. She's she got her first dividend check, which is awesome, but she'll have 100,000 invested by the end of the year, 50,000 in 16 months. She said, thanks for writing your book. I was like, no worries. Okay. Melissa, she had a recent experience where she actually had this wonderful company, wide moat, selling for a discount. Everything was perfect. And it got bought out. It got a bid. It was bid and it skyrocketed the shares and she sold out and she made $5,000 profit in a matter of months. It's amazing. So obviously you don't want to sell it. You want to keep it for a long time. And remember that it's in the waiting, but sometimes that happens and you're like, it's cool. So there's some great examples there, right? So you must be thinking like, if this is so simple, why doesn't everyone do it? Right?
And there's one main reason. They really just don't know where to start. Like they don't know physically how to, get started usually. Because you can give them these secrets, but if you don't know the first step to take, then you're not really going to do anything. So where do they struggle the most? What I've found is people struggle the most with this. How do I actually buy shares? Like what online broker platform do I use? How much do I start with? How many shares should I own? When should I buy? When do I sell? Right? All that stuff. Okay. So if you're kind of thinking about those things, right? All those things, it's normal. So let me ask you a question. Do you want some help? Do you want some help? You've been thinking about it for a while, don't really know where to start. You're like, yes, I would like some help. Yeah. Then all you need is go here. Right? You can you can do the QR code thing. It's sexy, right? The QR code, we're all used to that after COVID. So I put that in there. Or you can screenshot this. The other day when I did this, people were like, where's the link? There it is. investingmasterycourse.com. Really simple. And if you go there, you'll see there's a video. There's exactly what's included in there. And you can watch the video. And if you want to get help, you can jump in and you can learn and get all the secrets. This replay will be in there. You can watch it over and over again. And loads of content in there about how to get going. And I think it's really lacking, especially in Australia, but all over the world. People just don't know about this stuff. And you can't learn it at school. I didn't. And I went to university for quite a long time. And I still didn't learn it there. So that's why I wanted to create this for everyone so they can learn and teach themselves. All right. So there you go. So here's what I'll do. The first person to start, I'll give you a one-on-one call and I'll give you my personal watch list, what I'm watching at the moment, my personal watch list. So if you want that and you get started, the first person, I'll just give it to you. Okay. And we can set up a call and I can teach you a few little things, but it's mainly all in the course, right? So if you want it, go there. Simple as that. All right. Easy, easy, easy. And that's really it. They're that's the core principles, the secrets to value investing. The greatest thing about it is you don't need a high IQ to do it. You just need to have some secrets, bit of experience, and the right temperament. Okay. So I hope that's been valuable for you guys. I've really enjoyed giving this information. If you found it valuable, did you pop in the chat box your greatest takeaway maybe in the chat? Pop in there what you learned the most. I'd love to see. Yeah, Alicia says you don't need a high IQ. So pop in there what you learned the most. And thanks. Great value. I loved it. Thanks, Caesar. My man, Caesar, what's up? Thanks so much. Awesome. Great, great, great. All right, guys, you've been awesome. Thanks so much for tuning into the live. I'll just now stop the recording.